The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Examining Legislative Proposals to Reduce Regulatory Burdens on Main Street Job Creators. Before I begin, I would like to thank the witnesses for traveling to Rayburn 2128, making yourselves available for our questions. I also ask unanimous consent that any full committee members not on this subcommittee be allowed to speak at the conclusion of questions by the subcommittee members. No objections, so ordered. I now recognize myself for 3 minutes to give an opening statement. Well, good morning. Today we continue the subcommittee's focus on providing regulatory relief for Main Street job creators. Throughout this Congress, we have seen examples and heard testimony about how regulatory impediments prohibit job creation, cause consolidation of community financial institutions, and decrease the choices for our consumers. Some of the proposals we have already considered have received bipartisan support. Many of the bills before this subcommittee today are no different. For example, Representative Stivers introduced H.R. 2121, the Safe Transitional Licensing Act, which will ensure that workers who originate mortgages at depository institutions are able to move to non-depository institutions with a minimal amount of work disruption. This bill has very broad bipartisan support on the committee and in the House. H.R. 2473, for example, introduced by Ranking Member Clay and I, will ensure that small credit unions are able to more easily access the secondary mortgage market to ensure their members get competitive prices and robust credit availability. This bill is especially important in light of FHFA's proposed rule changing the membership requirements of the Federal Home Loan, and they will also help us achieve the policy objectives of reducing regulatory burdens for our job creators. I now recognize the ranking member for as much time as he may consume.
Thank you, Mr. Chairman, and thank you to each of the witnesses for your insight and your testimony today. Much of our work in this subcommittee has been dedicated to finding common ground on regulatory relief, and we have been partially successful in doing so. And today's hearing includes a number of proposals that provide real relief for Main Street, including H.R. 2473, as the chairman mentioned, a proposal that we have co-sponsored. I would caution my colleagues against proposals that have failed to attract bipartisan support and that undermine the implementation of Dodd-Frank, like H.R. 2896 and H.R. 3340, or like H.R. 2287, which seeks to pressure the NCUA into shrinking its budget just as credit unions become more complex. Regulatory relief is a worthy objective, but it should always be balanced against broader considerations, such as ensuring the safety and soundness of our financial system, protecting the independence of our financial regulators, and supporting the implementation of Dodd-Frank. Thank you again to each of today's witnesses, and I yield back the remainder of my time.
I thank the gentleman, and now the chair recognizes the gentleman from Colorado, Mr. Tipton, for 2 minutes.
Thank you, Mr. Chairman, and I'd like to thank the ranking member for holding this hearing. Reducing the regulatory burden for Main Street job creators like small banks and credit unions is certainly an important topic and should continue to be a consistent bipartisan goal of this committee. I would like to thank our witnesses for taking the time to appear before the committee today as well. I'd like to ask for unanimous consent to enter into the record letters from the American Bankers Association, the Independent Community Bankers of America, the Credit Union National Association, and the National Association of Federal Credit Unions supporting the Taylor Act.
Without objection, so ordered.
H.R. 2896, the Taking Account of Institutions with Low Operational Risk, or the Taylor Act, which I introduced with Representative Barr, is a legislative relief effort designed to give financial regulators the ability to appropriately tailor regulations to fit a bank or credit union's business model and risk profile. Banks and credit unions are currently regulated under a one-size-fits-all approach, regardless of the size or risk profile. This means that regulations designed and intended for big banks are also applied to small community and independent banks or credit unions, imposing compliance regimens and costs that many of them find unbearable. This legislation has the support of 37 co-sponsors and over 55 state bank credit union associations. Additionally, several regulatory agencies have recognized that banks and credit unions which engage in traditional banking activities should have their regulatory burden eased, and that is exactly what this legislation is intended to do. FDIC Chairman Thomas Honig noted that for the vast majority of commercial banks that stick to traditional banking activities and conduct their activities in a model that minimizes burdensome regulations. Research has also shown that one-size-fits-all regulations have made it harder for community banks customers to obtain loans, as well as making banking and credit services more expensive for small businesses. Those living in rural communities like the 3rd District of Colorado that I represent, and millions of American consumers and businesses that are more challenging to reach or more expensive for larger banks to service. This legislation will reverse that trend and help small banks and credit unions focus on their communities again so that Main Street can access the credit it needs for sustainable economic growth. Thank you, and I yield back my time.
I thank the gentleman, and now we'll introduce our panel, Dr. Paul Kupiec, who serves as a resident scholar at the American Enterprise Institute. Dr. Kupiec's work focuses on the study of systemic risk and the management and regulations of banks and financial markets. Oliver Ireland, who serves as a partner in the law firm of Morrison and Forster. Mr. Ireland's practice focuses on retail financial services and bank Dodd-Frank law. Each of you will be recognized for 5 minutes to give your oral presentation of your testimony. Without objection, each of your written statements will be made a part of the record. Dr. Kupiec.
Chairman Neugebauer, Ranking Member Clay, and distinguished members of the subcommittee, thank you for convening this hearing. It's an honor for me to testify here today. My testimony will consider the merits of 7 separate bills that are currently under consideration. In my opinion, none of these bills will magnify financial sector risks, nor will any of these bills dilute the Dodd-Frank Act's requirement for heightened supervision and regulation of systemically important financial institutions. Many of these bills propose common sense improvements to existing legislation. For example, the Safe Transitional Licensing Act of 2015 creates a 120-day grace period during which a licensed mortgage loan originator may continue originating loans while changing jobs and applying for a new license. The National Credit Union Administration Budget Transparency Act will improve accountability and management of the NCUA by requiring public disclosure and soliciting comment as part of the annual budgeting process. The Community Bank Capital Clarification Act amends Section 171 of the Dodd-Frank Act so that all bank holding companies with less than $15 billion in consolidated assets will be exempt from the Dodd-Frank Act mandatory holding company leverage and risk-based capital regulations. Bank holding companies below $15 billion, the $15 billion threshold, as of December 2009, were exempted in the Dodd-Frank Act because they were not seen as a threat to financial stability. I do not see why similarly sized institutions would pose a threat today. The Preserving Capital Access and Mortgage Liquidity Act of 2015 allows credit unions under $1 billion to join the federal home loan bank system without meeting the FHFA's proposed mortgage threshold rules. This amendment would merely put the FHLB membership requirements for credit unions on par with those of small banks. The Financial Stability Oversight Council Reform Act places the Office of Financial Research under the normal congressional appropriations and oversight process. The OFR should have been subject to these procedures from the beginning. 2 proposed bills are more involved and require a bit more explanation. The Taylor Act of 2015 requires bank regulatory agencies to modify their supervision and regulation practices so that they are appropriate for the risk profile of smaller institutions. There is a legitimate concern in Congress that the Dodd-Frank Act includes new heightened standards for supervision and regulation that were intended for larger institutions, but instead are being applied to all regulated depository institutions. The Taylor Act requires regulators to modify their one-size-fits-all approach to regulation and reduce regulations and processes that are burdening smaller institutions with unnecessary and unproductive compliance costs. Regulators must explicitly recognize the need to tailor regulations and supervisory processes and reflect this tailoring in their examination manuals and notices of proposed rulemaking. The final bill I will discuss, H.R. 2209, requires the banking agencies to amend their liquidity coverage ratio, or LCR rule, to give low-risk, highly liquid state and municipal bond obligations treatment that is consistent with their liquidity characteristics. The LCR requires large banks and bank holding companies to hold a sufficient quantity of highly liquid assets, or HQLA, to enable them to survive a hypothetical month-long bank run. The LCR has specific requirements that determine which bank assets count as HQLA. The final LCR rule does not recognize state or municipal bonds as HQLA, so they have no value towards satisfying the LCR requirement. Many public comment letters recommended that investment-grade, liquid state and municipal securities be included in HQLA. The reasons for counting state and muni securities in HQLA include the fact that many of these bonds are at least as liquid as the corporate bonds that are eligible for HQLA treatment. Many have higher ratings and better liquidity than some of the foreign bonds that are also eligible for Level 1 and Level 2 assets in the HQLA. And many asset-specific characteristics for the Level 2 and Level B requirements are met by many state and municipal bonds. There is concern that the exclusion of state and municipal bonds from the definition of HQLA will damage muni market liquidity, as banks will no longer favor holding these issues. In May 2015, the Federal Reserve Board proposed amending its LCR rule to recognize state and municipal bonds as Level 2 assets, which would count as HQLA. The H.R. 2209 will require the federal banking agencies to revise the final LCR rule to include qualifying state and municipal bonds as Level 2A assets in the definition of HQLA. This change is appropriate and consistent with the public interest. I would go further and recommend that state and municipal bonds that satisfy the characteristics required by Level 2B assets should also be recognized in HQLA. Thank you, and I look forward to your questions.
Thank you. Mr. Ireland, you're recognized for 5 minutes.
Thank you, Chairman Neugebauer and Ranking Member Clay and members of the committee. I'm pleased to be here today. My name is Oliver Ireland. I am a partner in the financial services practice at Morrison & Forrester here in town, and previously was an associate general counsel with the Federal Reserve Board. I was with the Federal Reserve System for 26 years before joining private practice. I currently have more than 40 years' experience dealing with bank regulatory issues. The subcommittee today is considering 7 different proposals that cover a broad range of issues. My testimony will touch on each of them. I look forward to questions and drilling down on details at the subcommittee's pleasure. The Taylor Act, H.R. 2896, would address the problem of regulatory burdens on smaller institutions due to requirements designed for larger and more complex institutions. Many of the provisions of the Dodd-Frank Act tried to differentiate between larger and smaller institutions, some of them in the statute, some of them in the regulations, but there is nevertheless a trickle-down effect on smaller institutions. Smaller institutions remain subject to some very complex rules, including things such as the Volcker Rule, and while in practice it shouldn't apply to any of their activities, they still have to understand the rule in order to be sure that it doesn't. So I think the Taylor Act is another step to try to address regulatory burden on smaller institutions. I think it's an important step. H.R. 2987, the Community Bank Clarification Act, would expand the grandfather for capital instruments for under $15 billion institutions. This is a technical change to the current statute. Drafting legislation, particularly in a crisis, response to a crisis such as the recent financial crisis, and creating the Dodd-Frank Act is hard work. They're bound to be technical issues. This is one of the technical issues. It's a cleanup, and I can't see any controversy, why there should be any controversy with respect to that provision. H.R. 2473, preserving capital access and mortgage liquidity, expands credit unions, access to Federal Home Loan Bank membership and Federal Home Loan Bank borrowings, and should promote credit union lending to smaller businesses, smaller farms, and community development organizations, and I think that is also desirable. H.R. 2121 is the Safe Transitional Licensing Act and deals with mortgage originator licensing under the SAFE Act and facilitates the movement of mortgage originators, individuals from depository institutions to non-depository institutions in between states. I understand that there is perhaps a subsequent discussion draft of that bill. There may be technical issues that need to be worked out, but I think the thrust of the proposal is good and will improve competition among mortgage originators, and competition improves quality. H.R. 2287 deals with budgetary transparency for the NCUA. I understand that bank regulators don't necessarily like to have their budgets scrutinized. I lived in a bank regulator for a long time, and I think at least the bank regulatory budget ought to be something that people are aware of and understand the purposes of and understand what's going on. I'm for budgetary transparency. H.R. 2209 deals with municipal obligations under the liquidity coverage ratio. I think that the failure to include municipal obligations as high-quality liquid assets in the current rules will adversely affect the liquidity of those obligations and will almost inevitably adversely affect the pricing of those obligations, making it more difficult and more expensive for states and municipalities to raise funding going forward. And as my colleague Dr. Kupiec pointed out, the risks of expanding high-quality liquid assets to pick up these assets are minimal. The Financial Stability Oversight Council Reform Act, again, is budgetary transparency and budgetary accountability for the Office of Financial Research. I think the people of the United States have a right to know how their money is being spent and oversight over that money unless there are serious issues in that the political process will impair those functions, which I don't see here. Thank you. I look forward to your questions.
Thank you, gentlemen. Now, Mr. Stanley, you're recognized for 5 minutes.
Thank you. Chairman Neugebauer, Ranking Member Clay, and members of the committee, thank you for the opportunity to testify before you today. AFR opposes H.R. 2287, H.R. 2896, and H.R. 3340. We also have some concerns regarding H.R. 2209. We have no views on the other bills under consideration today. The Taylor Act would mandate that federal banking regulators tailor regulations to the risk profile of regulated institutions. We view the specific requirements in this legislation as unnecessary, as regulators are already scaling rules to the business model of affected institutions. We also view several of the provisions in this bill as potentially harmful. H.R. 2896 requires federal financial regulators to limit the regulatory impact, costs, and burdens to regulated institutions. This broad and vague mandate prioritizes reducing the cost of regulation over the offsetting benefits gained for consumers and the general public. It would apply to all regulated entities and is not limited to community banks. While the requirements in H.R. 2896 sound reasonable in the abstract, their practical effect would be to layer additional requirements on an already lengthy and cumbersome rulemaking process and to create numerous litigation opportunities for the financial industry to challenge regulation in court based on the extremely broad and vague mandates in this legislation. H.R. 3340 would eliminate the independent funding for the Financial Stability Oversight Commission and its research arm, the Office of Financial Research, and also require that the OFR provide an advance comment period prior to issuing any report. The FSOC and OFR were created as a direct response to the grave weaknesses in the financial regulatory system that were revealed in the 2008 financial crisis. The inability to provide unified and coherent oversight of non-bank financial institutions, as well as the financial system as a whole, contributed directly to the financial crisis of 2008 and its disastrous impact on the U.S. and world economy. Political independence is crucial to the work of the FSOC and OFR. While there are many checks and balances built into the process of FSOC designation, including multiple appeal opportunities and the ability to challenge FSOC designation in court, the potential micromanagement of financial risk assessment through the congressional appropriations process should not be one of them. The importance of impartial risk assessment is the reason why all of our major bank regulators, including the FDIC, the OCC, the Federal Reserve, and the CFPB, are independently funded outside of the congressional appropriations process. The bill's requirement that the OFR solicit public comment prior to issuing reports on financial risk would also limit the independence of the agency and its ability to objectively assess risk free of outside pressures. H.R. 2287 would require the National Credit Union Administration to make drafts of their agency budget publicly available for comment and to respond to or incorporate such public comments in their final agency budget. We believe the budgetary requirement in H.R. 2287 is inappropriate for a public regulatory entity. The NCUA has the crucial role of safeguarding the taxpayer guarantee of publicly insured credit union deposits. It requires independence from those it regulates. While credit unions certainly did not cause the 2008 crisis, it is still important to remember that significant public action was required during that period to rescue the credit union system. This included the seizure and closure of several large credit unions and the issuance of over $30 billion in government-guaranteed bonds to stabilize the system. H.R. 2209 would mandate that banking regulators classify investment-grade municipal debt obligations as liquid assets under the liquidity coverage ratio. AFR shares concerns regarding the treatment of municipal debt in the LCR rule and raised similar concerns in our comment to regulators. However, we believe that given existing regulatory efforts to address this issue and the apparently quite limited impact of the LCR rule on the municipal debt market, it is more appropriate to leave this issue to regulatory action rather than act through statute. In relation to FSOC, which is related to the H.R. 3340 bill being discussed today, I would also like to mention another piece of legislation, H.R. 1550, that while not on today's legislation, may also be marked up by the committee soon. This legislation would at least double the time it takes for the Council to designate a large financial firm, from the current 2 years to at least 4 years. And it could create a situation where a large financial firm that is skilled at manipulating the process could delay increased regulatory oversight almost indefinitely. FSOC designation is already a multi-year process that includes some 10 major steps and multiple opportunities for appeal. Given the importance of the FSOC, Congress should reject legislation like H.R. 1550 that would bog down operations even further. Thank you.
I thank the gentleman, and now we'll recognize members for questions, and the chair recognizes himself for 5 minutes. I want to go to H.R. 2209, the municipal securities as high-quality liquid assets, and you know, as was mentioned, is that in the current rule that high-quality investment-grade municipals would not be HQLA. And so I think one of the questions that comes from that is, and I'll start with you, Dr. Kupiec, what is the consequences to these municipals and states if, you know, these investment-grade municipals are not allowed to be high-quality leverage assets, liquid assets?
Thank you. Any rule that limits a large set of financial institutions' ability to hold these kind of instruments cannot be a good thing for the state muni bond markets. It's got to increase the rates they pay on new issues. It would limit the liquidity rules, singling out types of instruments that can't be used to satisfy a liquidity requirement is like a feedback loop. If you can't buy the bonds, banks aren't going to buy the bonds. The liquidity in the bond market will go down. There will be ramifications. The bill under consideration, all it asks for is that if the bonds actually satisfy the specifications in the rule that would make them eligible for level 2A or 2B status, that they ought to be recognized. The rule is very explicit about the criteria, the liquidity criteria, and so if the bonds meet the liquidity criteria, why aren't we recognizing them? It seems to me a fairly straightforward way to improve the liquidity coverage ratio.
Mr. Ireland, you said in your testimony that the demand, how you talked about the demand for these securities generated by the designation would create liquidity and result in lower cost of funding. Can you also elaborate then how this designation can increase the demand by the banks for these municipal securities?
Well, I think a key feature is looking at the market liquidity and banks' investment incentives under the liquidity coverage ratio in conjunction with other rules. For example, the leverage ratio and the capital rules, and particularly the supplemental leverage ratio for larger institutions, to the extent that it's binding, tends to discourage institutions from holding lower yielding, high quality bond assets because it places the same capital charge on those assets as it places on higher yielding loan assets, for example. So as you're looking at your balance sheet, the larger banks are discouraged essentially from holding municipal securities because of some of the capital rules. And they will have an incentive, however, to hold securities that satisfy the liquidity coverage ratio rules. And things that are similar but aren't listed in the liquidity coverage ratio rules will suffer significantly. And I think you're going to start to see a cliff effect at the line between those eligible high-quality liquid assets and things that aren't. And so you're making the market through the rules. And if you leave the munis out of the rules, I think it's inevitably, as Dr. Kupiec has said, going to cost municipalities and states money in their funding.
It appeared to me that there was really kind of two losers in that. One is the states and municipalities, but also the banks in this very low interest rate environment. You know, a few basis points makes a lot of difference, and obviously the municipals have two advantages to them. One, a little bit higher yield, and the other is, you know, the tax consequences that of not being taxable or also enhance that yield a little bit.
I think it adversely affects everybody concerned.
Mr. Stanley, you mentioned in your testimony that there were some important safeguards in 2209 that you were complimentary of. Would you elaborate a little bit on those?
Yes, Dr. Kupiec mentioned those safeguards that the legislation does specify that in order to be eligible, muni bonds would have to satisfy the rules for liquidity, marketability, and being investment grade. And I thought that was good that that was specified in the statute.
Thank you, gentlemen. I don't really have enough time for another question, so I'm going to recognize the gentleman from Missouri, the ranking member of the committee, Mr. Clay, for 5 minutes.
Thank you, Mr. Chairman. Mr. Stanley, could you describe the regulatory capture concerns that are created by a process where credit unions are shaping their regulators' budget?
Yes, I mean, the concern is that the regulated entities, in this case, credit unions, would have an incentive to take risks with insured deposits. And the NCUA, of course, is in a supervisory role to ensure that they don't do that. So there are differing interests there. And if regulated entities could effectively punish their regulator for stringent supervision, for preventing them from taking risks that might profit the credit union but risk those insured deposits, then they could use the budget process to do that.
So H.R. 2287, if adopted, sets a dangerous precedent for other prudential regulators.
Absolutely. I mean, these are not self-regulatory bodies. They are public regulatory bodies protecting the public interest and protecting potential taxpayer exposure on insured deposits. And it's very important to keep that line clear.
What lessons did we learn from the financial crisis concerning the dangers of captive regulators and excessive industry influence on the budgets of prudential regulators?
Well, I mean, I think there were many lessons. There were regulators clearly ignored a massive buildup of systemic risk throughout the financial system. There appears to have been this kind of bidding process between different regulators where agencies like the Office of Thrift Supervision let it be known that they were more lenient as regulators in order to get the budgetary advantages of supervising particular entities. And in retrospect, the failures of risk management and the failures of regulators to spot these risks building up in the system were just egregious. And there's a lot in Dodd-Frank instructing and requiring regulators to take stronger action, and we need to not roll that back.
Is there any reason to believe that the credit union industry won't seek the same kinds of reductions in the NCUA supervisory resources that they sought from '01 to '09 when the NCUA held pre-decisional budget hearings?
Yeah, that's a great example. I was speaking more broadly about the financial crisis, but in the specific case of credit unions, the NCUA actually had fewer supervisors in 2009 than they did in the year 2000, despite the growth of the financial sector. And we had a major crash of the credit union system in 2009 and 2010 that required large-scale public intervention. So that's a lesson we need to learn from.
All right. At this point, Mr. Chairman, I have no further questions, and I yield back.
I thank the gentleman. Now I recognize the gentleman from New Mexico, the Vice Chairman of the committee, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. Appreciate each of you and your testimony. Now, one of the things that we have been wrestling with in our state is that the Dodd-Frank regulations were intended for the large institutions, but they bleed down to the smaller ones because it's impossible in the mindset of regulators to have two different mindsets when you walk in. So they're going to hold to the tighter regulations. Mr. Kupiec, are you familiar with any of the effects that this is having on financial institutions in the smaller rural states, the ones without the big mega banks?
I'm familiar with the general process you describe as working for a bank regulatory agency for many years. I am not particularly familiar with anything that's going on in any particular institution. The process, though, is kind of very natural. Within the bank supervisory community, the supervisors that are in charge of the largest institutions are generally thought to be sort of the best and the brightest. They're the top of the class, the ones that gets promoted, the ones that move up in the agencies. And this sort of creates this standard that all the other examiners, want to do exactly what the guys in the big institutions and women in the big institutions are doing. There's this very natural process where the regulations imposed on the most complicated regulations are the ones that everybody wants to use because it sort of promotes the examiner's career path. So there is a real sort of social force here that makes the more complex regulations feed down into the smaller institutions. It's pervasive in the way the examination process works.
If you've been inside the room doing the process, then maybe I would like to hear your observation on Mr. Stanley's assertion that tailored rules will limit the regulatory compliance impact, cost, liability, other budgets, and it will mandate the prioritization of the cost of regulations to financial institutions over the offsetting benefits to the consumers. Because I see that playing out exactly the opposite. There's nobody from a big institution in New York going to come out and give a loan for a mobile home in my district, and 50% of the houses in my district are mobile homes. And so there are people like Mr. Stanley who would say, no, they all have to come by the same rule, and it's not really unfair to the small people. Banks are closing at an alarming rate in the smaller states and the smaller rural communities, and there's nobody coming from D.C. to give small business loans and to lend money for trailer houses. So I would like your observations on his comments that would somehow disenfranchise the consumers out there. It looks like that putting them under the bigger regulatory standards of the big institutions is actually what's disenfranchising the consumers. Would you like to comment?
Yeah, I would say a good example of this is the rules that were promulgated by the Consumer Financial Protection Bureau on the mortgage underwriting standards, where small bankers in small towns had to adopt what were essentially the same practices that the largest banks would use to document all kinds of processes when, in fact, in a small town, those things may not be the right way to underwrite mortgages, that they took basically a computer-driven underwriting standard that would be applied in the largest shops and forced those standards to be reflected in the smaller banks. So that is exactly the kind of problem that these rules cause, and it does force smaller banks out of the business.
But you, as a former regulator, confirm that your observation is that the people who percolate to the top in the regulatory field are going to be the ones who come from the big institutions, and they have that bias towards everyone following the same rule. And so you're confirming that. Mr. Stanley, I mean, I would love to hear your observation as to why that we in the small community shouldn't be screaming at the process which is eliminating our access to capital. The poor people in New Mexico are not going to be able to get a loan off of Wall Street. Believe me, when you succeed and people with your viewpoint succeed in shutting us down, we have got nothing else. So I appreciate your observations.
Well, let me say, first of all, to take the case of the CFPB, the CFPB did provide extensive exemptions for small banks and banks in rural communities from those underwriting provisions, the qualified mortgage provisions that Dr. Kupiec refers to. And I would also say, you know, if our concern is, say, banks under $1 billion, which make up a very substantial portion of community banks and are, I think, the community banks where we have the economic issues, let's limit these bills to banks under $1 billion. Let's put size limitations on these bills.
Mr. Chairman, before I yield back, and I appreciate that, but those safeguards that were put into the bill, you hear, are being routinely ignored because the bias inside the agency says so. Again, yield back, and I appreciate your response there.
Gentleman's time has expired. Now recognize the gentleman from Texas, Mr. Hinojosa, for 5 minutes.
Thank you, Chairman Neugebauer and Ranking Member Clay, for holding this hearing, and thank you to those distinguished panel members for your appearance and testimony here today. Small businesses and Main Street are the lifeblood of our economy. We should be doing everything we can to ensure that Main Street America is able to prosper. Sadly, however, this Congress is going down a path fundamentally hurtful to Main Street. While this committee examines legislative proposals aimed at helping Main Street, the House today considers H.R. 692, the Pay China First Act. This H.R. 692 is nothing but default by another name. Moreover, adding insult to injury, H.R. 692 mandates that we pay foreigners instead of American service members and veterans. Rather than acting responsibly, this Congress prefers to play Russian roulette with our economy and the lives of millions of Americans. Raising the debt ceiling does not increase the deficit nor authorize new spending. It merely pays the bills this Congress has already authorized. Raising the debt ceiling is the only responsible thing to do, is my opinion. My first question goes to Paul Kupiec. H.R. 2209 would consider muni bonds that are liquid and readily marketable, as well as investment grade, to be treated as level 2A liquid assets. The banking regulators appear to have been unable to fairly or effectively differentiate between municipal securities. So, by skirting the regulatory process, is Congress essentially picking winners and losers between financial asset holdings for banks and financial institutions?
So, thank you very much for the question. I don't think the Congress is necessarily stepping in to pick winners and losers. What I think they're doing is stepping in to encourage the bank regulators to actually pay attention to this problem. As I mentioned, in May, the Federal Reserve Board introduced a notice of proposed rulemaking to allow munis to be considered as level 2B assets, even though they passed the final rule the prior October, and didn't permit muni assets in. So the Federal Reserve Board has begun to start to rethink the rule and change the rule. And what the committee has merely said was, well, this is a good idea, speed it up. But if they qualify as level 2A assets, why aren't you counting them as 2A assets?
Let me ask you then, if of the more than 90,000 municipal insurers that include states, cities, schools, hospitals, which municipalities would you expect would qualify as liquid, readily marketable, and investment grade? And give me a few examples.
I wouldn't give you names right off, but I'm sure that you are wanting me to say it's the larger municipalities and states, and I would have to agree that's probably the case.
Those in small communities like mine and my former speaker, I think that we're very concerned that the small ones would be hurt. Let me ask you this last point. Did NCUA, did they voluntarily between 2001 and 2009 lead to a substantial reduction in the NCUA budget during that period and left the agency insufficiently resourced to respond to the credit union failures during that 2008 financial crisis?
I am not versed in what happened internally in the NCUA over this time, but I would say that all of the financial regulators were unable to respond to the crisis. So I don't think it was particularly a unique situation in NCUA, and I'm not sure just allowing budgets to be produced without any public accountability or with public knowledge fixes the problem.
Mr. Oliver, Ireland, the Taylor Act would require the federal regulators to engage in additional, is my time up? I yield back.
I thank the gentleman, and now the gentleman from Missouri, the chairman of the Housing and Insurance Committee, Mr. Luckmeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to start out with going and talking about House H.R. 2987, the Community Bank Capital Clarification Act. And I think basically it's kind of a unique piece of legislation because I think it kind of addresses a unique problem here from the standpoint that within Dodd-Frank there is a problem that's arisen with regards to trust preferred securities that are used as Tier 1 capital or count toward it. In Dodd-Frank, it stuck in there a date of any bank holding company that is $15 billion or more at that point in time goes into a separate set of rules, and those under don't. And what happens if the institution gets rid of its Tier 1 trust preferred securities is it get to fall back, and there's no provision for that to allow it to happen, so they're kind of stuck in limbo here is my understanding. And so, Mr. Ireland, I want to ask you if my interpretation of that is correct, and what kind of institutions are going to benefit from this bill?
First of all, I think your interpretation is correct. I think it's basically a drafting glitch in the original Dodd-Frank Act, and an institution that downsized since 2009, the 2009 grandfather date in the bill, and was above $15 billion in the holding company before that, and became below $15 billion afterwards because perhaps they sold off some of their units or for other reasons. They are now a smaller institution, but they don't get the same treatment as other smaller institutions. And I just don't see the logic of that difference.
Dr. Stanley, is there any meaningful advantage to examine the bank's capital adequacy at a date back in time like this?
Excuse me, I didn't quite hear the
Is there
question.
any meaningful advantage to examining a bank's capital adequacy at going back in time to a historic date like this?
We don't have views on this legislation. We don't have an objection to it. I don't think.
You realize then it's a glitch. We need to kind of fix the problem so that those banks that are inadvertently caught here in this trap can get this thing fixed.
Yeah, I think that that $15 billion line is one example of many, many places in Dodd-Frank where there was an attempt to restrict the impact of these new rules and regulations to larger banks. And if you have a bank that's now legitimately a smaller bank, I think that it makes sense not to apply it.
Appreciate your support. Thank you. I know that the gentleman from Colorado has got a great bill, I think, here, the Taylor Act, and I don't want to steal his thunder, but I do have one comment about this bill because I think it's extremely important that, in my judgment, what he's trying to do here is that within 3 years have the agencies revisit the rules that they've implemented since the passage of Dodd-Frank. And to me, this is just common sense. You know, anytime you do anything in the business world, you're constantly reviewing to make sure that the decisions you made are accurate, the decisions you made actually work. And if, in this situation, what we're trying to do is take a common sense approach to these rules and have the regulators go back and take a look at them. Maybe they need to be strengthened. Maybe they need to be weakened. They're too tough. But we won't know unless we review them and find out the impacts, because none of these rules were created with an impact statement, with any sort of cost-benefit analysis. They were all just thrown out there in this bill, and it's been 5 years. So let's stop and think about this. So I know Mr. Kupiec and Mr. Allen, both of you had some very positive statements to say about the Taylor Act. I wonder if you'd like to, Dr. Kupiec, make a couple more judgments on it.
I just think it's a good idea to move forward, to put the regulatory agencies on notice that you do expect the rules to reflect the risk profile, and I can't see why this isn't a good idea.
You know, it's interesting because I think the regulators, when they go in and examine the banks, they're going to require that the banks review their loan files, their loan documents on a regular basis. So why shouldn't the regulators go back and look at their rules on a regular basis? It makes sense to me. Your opinion, Mr. Allen?
This is an old problem. We've had this for decades, that the regulatory system focuses on the larger bank problems, the burdens trickle down to the smaller banks, and the regulators trying to solve the bigger problems don't adequately adjust for the impact on smaller banks. There are numerous examples of legislation trying to fix the problem, but it's still here and we haven't fixed it. And I think everything Congress does to draw attention to it is beneficial to small banks, small businesses, and the customers they serve.
Thank you. I yield back the balance of my time, Mr. Chairman.
Thank you, gentlemen. And now the chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. These 7 legislative proposals that we're considering today serve, in my opinion, as a positive step to help reduce many of the regulatory burdens. But I am particularly supportive of H.R. 2287, which would require the National Credit Union Administration Board to submit a detailed draft of their budget to the Federal Register for comment and hold public hearings. Now, I think it was about a month or so ago, but the NCU chairwoman, Ms. Debbie Matz, appeared before this committee and gave us a very interesting testimony. But the record will reflect that her testimony revealed a very severe need for our particular legislation, because our legislation would simply have the NCUA be held accountable for its budget and would allow the credit unions that they represent to take a more active role in its budget decisions. And I believe that our bill with Representative Mulvaney providing the leadership will do just that. It's very necessary from her testimony to really show how crucial it is to do this so that we can build a more positive relationship between the NCUA and the credit unions that it represents. And so I wanted to make that clear, Mr. Chairman, because this is one time that a hearing has produced a great need for legislation, and this committee has, under the leadership of Representative Mulvaney, has provided just that leadership, and I'm proud to work with him on it. But I would be interested, Mr. Ireland, I'm concerned about smaller banking institutions and the larger banking institutions. Could you explain more about the stratification that smaller banking institutions experience regarding trying to implement risk-based models compared to our larger banking institutions?
Sure. The problem, and we've seen this now, we've seen constant consolidation in the banking world. Banks keep getting bigger over time. One of the things driving this is the regulatory costs of being a bank and doing compliance. And if you're a smaller bank, you have to understand the regulations you have to comply with, and you have to put in place compliance programs. And that's even if the rules, like the Volcker rule, are designed for much larger banks, you're still not completely exempt. And then you have to spread the cost of that regulatory compliance effort over a much smaller base. And so it drives up the cost to the smaller banks and makes it less economic for them to operate. A $500 million bank can't proprietary trade under the Volcker rule. How a $500 million bank can tell whether or not it's proprietary trading, it doesn't have the money to sit down and read that 800-page Federal Register notice and sort out the 2,500 or 3,000 footnotes in it. So the burden on smaller banks is disproportionate to the burden on larger banks.
All right, and there's another bill that I think is also very important, and that's by Representative Stivers, House Resolution 2121, concerning the difficulties that loan originators face when moving to another state or seeking a license. Could you give me some examples of those difficulties, Mr. Ireland or Mr. Kupiec or Mr. Stanley, either one?
Well, I'd be happy to address that. One of the problems is that you have to become licensed as a loan originator. There is, if you're not in a bank. You have to be registered if you're in a bank. So if you're in a bank, if you work for a bank as a mortgage loan officer and you want to move to a non-bank, you have to become licensed. And there's going to be a delay in that process. And what this bill would do is to provide a 120-day transition period so you can work while you get the license as you move to the non-bank provider. And the same kind of thing works in moving from one state to another. Fostering mobility among individual loan originators, people who work in the business, fosters competition and is going to make the system work better. And so I think this kind of thing makes a lot of sense. There are in this bill and in the other bills some details that may need to be worked out, but I think moving in this direction is something that the committee wants to.
Thank you, Mr. Ireland.
I now recognize the gentleman from South Carolina, Mr. Mulvaney, for 5 minutes.
I thank the chairman and the ranking member. Also thank Mr. Scott for his input on 2287, which I want to review very briefly. I wish that Mr. Hinojosa was still here. He had asked a question earlier about the NCUA budget from 2001 through 2009, and I think he implied in his questions that the budget had gone down to the point where the NCUA is not able to deal with the financial crisis. I'm looking at the numbers from 2002 through 2009. They didn't go down. And I haven't heard anybody here claim that they were unable to deal with the financial crisis. In fact, everything I've heard about the credit unions is they weren't really part of the financial crisis to begin with. That they may have faced some challenges that came with a larger overall declining economy, but that certainly they were not at the epicenter of the difficulty. So I wish that he were here to hear that, because I think that concern, and the reason he raised it, by the way, for those of you who followed 2287, is the NCUA is now claiming that if we have to go back to the system as we had between 2001 and 2009, that they won't have enough money, that additional insight and oversight by the folks that pay the bills will effectively drive the regulator out of business. That is simply not the case with the historical numbers from the period of time when they used to do that. They used to have that type of oversight from 2001 to 2009, and when Chairman Metz came in, she stopped that practice. So just to set the record straight, we don't have a problem historically. There's no correlation between oversight and participation and the NCUA not being able to do its job. Now with that, there's another complaint, Mr. Ireland, that Ms. Metz is making now, which is that if you go back to the old system, it will cause the agency to, will jeopardize the agency's policy independence. How would you respond to that, sir?
Well, I don't think transparency without control jeopardizes their independence. So if what you're saying is you're going to make your budget public, you're going to solicit comment on your budget, and you're going to respond to your budget, that puts you through a discipline to justify what you're doing. It doesn't cede control of the budget to somebody else. It doesn't mandate reductions in the budget. I think that adds discipline to the budgetary process, and I think the NCUA and, quite frankly, the rest of the bank regulators in their bank supervisory activities can only benefit from that kind of discipline.
And again, for people who are not familiar with the issue, the money to run the NCUA right now comes from the credit unions. And since credit unions are owned by their members, it's actually the members' money that is going to fund the oversight. And without the participation of the credit unions, there's actually nobody there watching after the members' money. Not us and not them. It's the sort of the reason we've introduced 2287. I do want to point out for the record that Ms. Matz has offered to have a public hearing. She just announced it this past Friday, but I understand she will not be publishing the budget before that hearing. Even though she said she'll welcome questions about the budget, she's not going to publish it. By the way, when she was here last time, she promised us that that would be on the website. And I don't know how you reconcile those two things. If it's not available before the meeting, I'm not sure what the meeting is. I also understand that at least one board member was not made aware of that meeting, and that's the type of atmosphere that I think is unhealthy when we have a federal regulation. Mr. Stanley, I'll press you on one issue because you've checked in on the other side of this issue, which is that you think that the NCUA should be outside of what you call, you should be free from politics, I think is your words. If I'm misstating that, please let me know, but that's what I've got in your testimony, that it should be free from politics. So let me ask you a question. Let's put FSOC and NCUA aside. What other federal agencies would you like to see free from politics?
I'm not sure it was free from politics exactly, but I think the issue is that the entities that an agency regulates are only a small portion of the entire public interest. They're just one aspect of our economy and of our public, and there's a broader public interest. For example, the NCUA has oversight over insured deposits, and there may be exposure to the U.S. Treasury if there are sufficient losses on those insured deposits.
But
so
how
there's
would
a
more
public interest that's different
I'm not
there.
disagreeing with you, but how would more transparency and participation in the budget process put that in jeopardy?
Well, I think there's already extensive transparency in the NCUA budget. They put up a very extensive justification of their budget and all the details of their budget numbers on their website. I think what this bill seems to call for is the involvement of regulated entities.
It's not available to the folks before this meeting next week. How can you say that?
Well, I mean, I think that when they finalize their budget, it's available. I mean, people can see what that budget is and what that justification is. And certainly they can raise an issue. I think the issue is bringing regulated entities into the process of setting the budget in advance.
Fair enough. We are a regulated entity. We represent the taxpayers, and we bring the taxpayers into the process of looking at their regulators' budget every single day. It seems to have worked for the last 240 years. Not well all the time, but it does seem to work. With that, I'll yield the balance of my time. Thank you.
I thank the gentleman, and now the chair recognizes the ranking member of the full committee, the gentlewoman from California, Ms. Waters, for 5 minutes.
Thank you very much. I'd like to pose a question to Mr. Stanley. Mr. Stanley, H.R. 3340 would eliminate the independence of the Financial Stability Oversight Council and the Office of Financial Research by subjecting their budgets to the appropriation process. In your opinion, what would be the effect of this legislation? What are the benefits of having an independent counsel to monitor systemic risk as well as an independent research office to support that mission?
Well, I think that this kind of relates to the previous question that was asked. I think we've all seen in Washington, D.C., that there can be a narrow interest with money at stake that can hire lobbyists to influence the process and have an untoward influence on the process. And those narrow insider interests can come to dominate processes like financial regulation. And I think the benefit of having some independence for these financial regulatory agencies is that they can make their own calls on the risk to the broader public, the potential risks to the broader financial system and the public, including risks to people who maybe are not the insiders here in Washington, D.C., who don't have the ability to hire lobbyists to monitor all these issues constantly. And these regulators need the independence to make that right call for the public interest, even if it could cost a regulated entity some money over the short term. And we saw in the lead up to the financial crisis the price we pay when that doesn't happen, including for entities like credit unions. 5 of the major corporate credit unions failed, and there was $30 billion in U.S. government bonds put out to support them. So I think FSOC independence is very important to make those calls.
Would you agree, Mr. Stanley, that FSOC, that is the Financial Stability Oversight Council, is an extremely important part of Dodd-Frank reforms? It's in Title I, and you have just alluded to the management of risk. And would you agree that this agency should be absolutely independent and not interfered with, again, by special interest or politics, that if we are to deal with the subprime meltdown and the crisis that was created, that we absolutely need to have FSOC being able to identify a risk and to deal with it?
Yeah, I mean, I do think the FSOC is one of the absolutely central elements of Dodd-Frank, because when you look at so many of the entities that were involved in the financial crisis, they were not traditionally regulated commercial banks. They were investment banks who were following a capital markets model, who at that time were not regulated as commercial banks. They were insurance companies like AIG. And as our financial sector morphs and evolves, free of the limits that were once put on it by Glass-Steagall, you get a lot of lending and financial activities taken over by non-banks, and it's crucial to be able to monitor that process and spot emerging risks. And regulators fell far, far behind in that process, and we can't let it happen again.
Thank you. And I'd also like to ask another question. H.R. 3340 would also require OFR to first solicit public comment before issuing a proposed report, rule, or regulation. Are you aware of any agency that is required to first seek public comment on the substance of a report they haven't yet published? What would be the effect of imposing this requirement on the OFR? Is there any harm in allowing the OFR to first publish a proposed report prior to seeking comment?
Now, I'm not familiar with any requirement that reports be somehow pre-cleared with interested parties before even just putting that report out to the public. I mean, a report is not a regulation. A report is something that's an attempt to inform the public and inform the public debate. And if people disagree with that report, they're perfectly free to contend with it after it's out there in the public and produce new information and data. And we've seen that happen with OFR. And I think to some degree, the idea that you're going to pre-clear these reports would impoverish the public debate. It's almost an attempt to allow that it could result in censorship of information before it reaches the public. And I think that's a problem.
I thank you very much, and I yield back the balance of my time.
I thank the gentlewoman, and now the gentleman from North Carolina, Mr. Pittenger, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank each of you for being with us today. I would like to thank Congressman Emmer for his role on the FSOC reform bill, and particularly as it relates to the budget process or lack thereof and the need for greater transparency and accountability. Dr. Kupiec, do you believe that there's any limitation at all in the funding opportunities for FSOC and OFR?
I'm not, limitations. So in terms of the,
Could they, for example, double their budgets every year if they wanted to?
I think they have a revenue stream, so I'm not sure of the size of their budget relative to their revenue stream at the moment. But in terms of the FSOC and the OFR, this notion that they're independent is insane, as far as I can tell, because the Secretary of the Treasury is the head of the FSOC, and the head of the OFR has an office in the Treasury and meets with the Secretary of Treasury all the time. I don't know how that would be considered independent in any world that I'm aware of. So this whole notion that they're completely independent of politics and their budget must be completely independent of politics doesn't make any sense to me. They are part of the political system, very much so. And the notion that their budget should be outside the regular government appropriations is strange to me. My understanding is the proposed bill would not affect the way that financial institutions have to fund the OFR, but it would affect how much of those resources the OFR were allowed to spend. It would be subject to the normal congressional process. And I don't see why they have any particular role or are absolved from politics in any way at all and shouldn't be subject to the congressional budgetary process and oversight.
How about disclosures? Do they disclose less information than comparable entities like the Fed?
I'm mostly familiar with OFR studies that they put out and comment on them, and many of them have been very political in nature. And I think part of the reaction in this bill is, in fact, that before an OFR study becomes final, that people should be able to weigh in and claim foul if they think the OFR is producing political research instead of dispassionate research. And I think that's my opinion about the reaction to this, and it's exactly because the OFR and the FSOC are not independent agencies.
Mr. Allen, would you like to comment?
I think on the report issue, I think there was an example where the OFR put out a report on asset managers, and the SEC subsequently went to the lengths to solicit public comment on it. You only got public comment through the SEC, and there were valuable comments submitted. I think there were a lot of misunderstandings in that report and perhaps some factual errors. I would also point out that the members of the OFR all have their own budgets. We're not talking about the FISOC members having their budgets cut or the actual regulators having their budgets cut. We're talking about transparency and the appropriation process for a research arm that supports essentially the Secretary of the Treasury. And the Federal Reserve Chair Yellen has her own research people who can research FISOC issues and do research FISOC issues. So you're not really impairing the operation of FISOC. You're dealing with part of the Treasury and putting part of the Treasury in the appropriation process like most of the rest of the Treasury is.
How about openness as it relates to public notice of meetings? Are they required to give any public notice?
Their meetings are generally not public, and you know, there is substantial litigation by one of the entities that's been designated as systemically important based on the reasonableness of the process that was gone through, and I think some transparency into that process would be beneficial for all concerned going forward.
Dr. Kupiec, any comment?
I mean, I agree with Mr. Ireland. The FSOC meetings, there's a closed portion and sometimes an open portion that's available for the public. I'm not aware if the law requires them to be announced ahead of time or not. I'm not that familiar with the details of that part of it.
Thank you very much. My time has passed.
Thank the gentleman. And now the gentleman from New York, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, we often speak of providing regulatory relief for small banks, and I think if we are serious about it, we should start by making quick fixes wherever possible where we can offer some immediate relief. So I introduced H.R. 2987 along with Representatives Maloney, Representative King, Representative Lukemeyer to provide a technical correction on Section 171 of Dodd-Frank to allow small banks with less than $15 billion in assets to be able to continue to use their trust preferred status as part of their Tier 1 capital. The intent of this section of Dodd-Frank was to make sure that the large banks have high-quality capital, while providing an exemption for smaller banks with assets under $15 billion. But I believe it was a mistake to set in law a fixed date of December 31st, 2009 as a permanent judgment date for determining which banks had less than $15 billion in assets to qualify, regardless of what happened to the size of the institutions in the future. This is, one, inconsistent with other legislation that uses assets thresholds like the CFPB $10 billion threshold or the SIFI's $50 billion threshold. All these thresholds are based on the size of the institution today. It is also unfair to institutions that are currently as small as $6 billion today, but are still regulated like large banks with over $15 billion. This bill would allow banks that have assets of less than $15 billion today to be treated fairly and therefore be eligible for the exemption that was meant to be available for such small institutions. And in this bill, we make sure that the intent of Dodd-Frank is entirely preserved, as if the bank's assets go back to above $15 billion, then they lose that exemption. So this bill will provide relief for institutions that go below $15 billion for as long as they remain below that level. This is a simple fix, Mr. Chairman, and it is also logical. And these banks need the relief, and they need the relief now. Mr. Chairman, I hope we can have this included in our next markup and approve this legislation as soon as possible. And I'm pleased that this is one of the pieces of legislation that we were able to do in a complete bipartisan manner. We have over 40 co-sponsors and about half and half, 50% Republicans and 50% Democrats, and I want to thank my colleagues on both sides of the aisle for their hard work on this legislation. Lastly, I believe that high-quality municipal bonds, some of which are more liquid and less risky than highly rated corporate bonds, should be included in the definition of Level 2A high-quality liquid assets in the LCR. This is critically important for cities like my little city, New York, a little small city on the coast, and is another important improvement that we need to approve. So, in the length of time I have left, I'll just ask to the witnesses whether or not you think that banks should be regulated today based on the size of their assets back in 2009, or do any of the witnesses believe that banks under $15 billion pose a systemic risk to the financial service industry? Gentlemen.
I agree with your statements. That it makes a whole lot of sense that the 15 is changed not to reflect a given date in the past.
Mr. Ireland?
I would agree. I think that the 15 should be an ongoing number, and if you're below 15, you get the benefits, and if you're above 15, you don't. And I'm hard-pressed to think of a $15 billion institution as systemic.
Mr. Stanley?
We don't have a position on this bill. We do feel there were a lot of problems in the trust preferred securities market, and it's positive that regulators took action, but it is possible that certain banks are caught up inappropriately in that. We haven't examined the issue closely enough.
Okay, we want you to research it and come back and give the same answer to Mr. Ireland and Mr. Kupiec. I yield back the balance of my time, Mr. Chairman.
I thank the gentleman, and now the gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I'd like to thank our panel again for taking time to be here. One of the primary concerns I hear out of our district from small, locally owned banks and credit unions is the cost of compliance. Dr. Kupiec, you mentioned in your testimony the tendency for banking regulators to apply best practice supervision on supervised institutions. If you'd speak to how does this impact those institutions, and as well the Taylor Act will require regulators to examine potential unintended impact of examination manuals or other regulatory directives, and that works in conflict with tailoring the regulatory actions. Will this alleviate some of that impact?
Yes, thank you. The tendency for for large bank, the examination and regulation of the largest banks is really to adopt a very data-intensive approach where you have large databases and comb through the data and use models and apply all kinds of fancy statistical techniques which may or may not work, but we have a tendency to like to do that in the largest institutions to create very complex regulations. And this permeates down through the examination team of examiners. They, if you want to move up in the world, you want to be a big bank examiner, not a small bank examiner. And what's the best way to do that? Well, you try to learn what the big bank examiners are doing, and you try to impose it on the banks you're examining, so that you get experience in the field, you get recognized. I think it's a natural problem with the system and then it starts imposing more and more data requirements, more and more data processing, the need for more and more vendor models, all kinds of things for small banks that probably really aren't necessary and don't have a benefit. So that's my experience working in a bank examination agency.
So essentially, Mr. Stanley had asserted that there were exemptions that were created for small banks. You're stating that's not really the reality. We're seeing the unintended consequences of regulations that are impacting small banks, and just having regulations that the Taylor Act would require that are going to be sculpted for those institutions would make good common sense?
I think what Mr. Stanley says is technically correct. There are lots of places in the law that differentiate between the size of the institutions. However, there's never a clean break between a certain size and another size. It depends on the business practices and what kinds of loans they're, what kind of area it is. There's all kinds of considerations, and I think the Taylor Act speaks more to a duty and requirement of the regulators to pay attention to these differences, whereas the very sharp limits in the current law are really not up to the task of differentiating really between risk profile and the best public interest of what's really required.
Thank you. You know, one of the frustrations that we hear, I'd had the opportunity to be able to serve on a small local bank and used to be able to make what were called character loans, knowing the people that you actually work with. And I'd like to be able to give you one example that's out of my district. I have a small business in Vail, Colorado. It's a ski and bike rental shop, had it for over 20 years. This gentleman applied to refinance his primary residency, but based on a 2-year average of his 2013-2014 tax returns, he didn't qualify. His 2015 profit, however, P&L statement showed that his net income was in excess of the 2014 tax return, but it could only be used to be able to support the 2-year average unless he paid thousands of dollars to be able to have an accountant review his 2015 financials. In the end, he had to be able to pay off a couple of auto loans that he had to his detriment in order to be able to qualify. This signals to me the loss of that relational banking ship that I think is so important in our community banks. Mr. Ireland, will tailoring regulations to community banks and credit unions, would this model enable these institutions to increase consumer and commercial access to credit?
It should. I think that's the intent, and if the regulators respond appropriately to it, they should lessen the burdens on smaller institutions, and character loans should come back. We saw this problem in the 90s in response to the thrift crisis. The character loans dried up. We're seeing it again. The regulators try to do things risk-based, but risk-based often means we're going to increase the scrutiny on the bigger guys. We're not going to reduce the scrutiny on the smaller guys, and the scrutiny trickles down. It just does. We tell banks to look sort of one layer up in the regulatory tiers in doing their own planning just to be safe, because that's what the examiners tend to do. That's the standards they tend to hold them to.
Great. Thank you. My time's expired.
Thank the gentleman. Now the gentlewoman, excuse me, from New York, Ms. Maloney, is recognized for 5 minutes.
This hearing on these important bills, and I have two that I'm particularly concerned about, and I'd like to ask Paul Kupiec about H.R. 2209, which Mr. Messer and I introduced earlier this year, that would level the playing field for our cities and states by requiring the banking regulators to treat certain municipal bonds as liquid assets, just like corporate bonds. And as a former city council member, I know the importance of many muni bonds to allow states and cities to finance infrastructure, schools, pave roads. Unfortunately, in the banking regulator's liquidity rule, which requires banks to hold a minimum amount of liquid assets, the regulators chose to allow corporate bonds to qualify as liquid assets, but completely excluded municipal bonds, even municipal bonds that are just as liquid as corporate bonds. And this makes no sense and threatens to raise borrowing costs for municipalities across this country. The Fed has already recognized this error and is amending its rule to allow certain muni bonds to count as liquid assets, but the OCC is still refusing to amend its rule and insists on favoring corporations over municipalities. So I'd like to specifically ask you, Mr. Kupiec, if you considered two identical bonds, same size, same maturity, same everything. Both bonds are liquid enough to satisfy all of the liquidity criteria in the OCC's rule, but one bond was issued by a corporation, one was issued by a local government, and under the OCC's rule, the corporate bond would be considered a high-quality liquid asset, but the muni bond would not, even though they have the exact same liquidity. Do you think that that is a fair outcome?
No, I support the law. There's another issue here that the Fed is considering level 2B treatment, which is pretty limiting. You're only allowed to count 50% of the value, market value of the bond, and only up to 15% of your total LCR requirement. So the Fed's proposal, which they haven't put out any final more information on, they just put out a notice of proposed rulemaking, would still limit muni treatment for those that satisfy at least level 2B criteria to level 2B. But there are many muni bonds and state bonds that satisfy level 2A criteria, and the bill under consideration would require the regulators to recognize those liquidity characteristics. I think the LCR rule has a lot of issues with it. It's causing a lot of difficulties in a lot of places, including large banks not wanting to take deposits anymore. So I think that it certainly is a rule that merits some attention from Congress, and I think this is a good idea.
Thank you. I'd like to ask Mr. Ireland if you would comment on the Community Bank Capital Clarification Act, which I have co-sponsored with Mr. Meeks and several Congresses. In Dodd-Frank, we allowed community banks with less than $15 billion in assets to keep counting certain securities they had already issued as capital. But for some reason, Dodd-Frank said that in order to qualify for this relief, you had to be less than $15 billion in assets on December 31st, 2009, even though we didn't pass Dodd-Frank until 6 months later in 2010. And I can tell you that that was not intentional, but we did not update that date to reflect it then. So this bill simply states that for banks that were only briefly above $15 billion in assets on December 31st, 2009, but have fallen below that threshold and continue to be below that threshold, that they should be treated like other banks below that threshold as community banks. So I'd like to ask you if you think there's any reason why we shouldn't treat banks that are currently under $15 billion and will continue under $15 billion as community banks for capital purposes.
I can't identify any.
Pardon me?
I can't identify any reason why you wouldn't adopt this provision.
Why we would adopt it?
Why you wouldn't adopt
Why
this.
we would? I agree. I think it's just common sense.
It's just common sense. I can't see why you wouldn't do this.
Thank you. Thank you for that statement. And we have many members of Congress who feel very, very much the same way. And I'd like to follow up, Mr. Kupiec, with you on the OCC has been able to distinguish between liquid corporate bonds and illiquid corporate bonds. Do you think it would be possible to distinguish between liquid and illiquid municipal bonds as well, to be able to distinguish as the Fed has proposed? In other words, why don't we treat the municipal bonds fairly? That's
my understanding is that the public comments on the rule have done analysis and identified many state municipal bonds that are more liquid than the corporate bonds that are given level 2B treatment now. So the answer is you can distinguish, and I think they should include them.
Well, my time has expired, and I thank you for your wisdom and your comments and support for these bills. Thank you.
I thank the gentlewoman, and now the gentleman from Texas, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to all our witnesses for being here today. And I'm a small business owner in Texas. I'm a car dealer. And you can imagine what I think of the CFPB on how they're issuing laws and so forth, but also that's quite evident, too, they've largely ignored congressional intent. Now, as a member of this subcommittee, I'm proud to have co-sponsored many of the proposals we're discussing today, including H.R. 2121, H.R. 2897, and H.R. 3340. All these proposals will help reduce regulatory burdens facing so many families and small businesses in America today, and again, speaking of Main Street. Now, I want to take a second and focus on H.R. 3340, sponsored by my good friend, Congressman Emmer. His proposal, which ultimately brings the budgets for the Financial Stability Oversight Council and Office of Financial Research under appropriations, will no doubt provide for greater transparency where it is sorely needed. My first question to you, Mr. Kupiec, is the following. Has FSOC been transparent through the process of designating MetLife, Prudential, General Electric Capital, and American International Group as non-bank SIFIs?
No, I don't think they have.
Mr. Ireland, what do you think about that?
I would agree with Dr. Kupiec. I don't think they've been transparent either.
Mr. Stanley?
Well, they provided a public justification of their decision that was fairly extensive, and I believe the FSOC process provides extensive transparency to the companies that are being designated. A lot of that information in that process is not made public because there can be trade secrets involved.
Okay. Next question to you, Mr. Kupiec and Mr. Ireland. How has the non-transparent designation process for non-bank SIFIs been harmful to consumers and taxpayers?
I think any process where you can impose new sweeping regulations with no justifiable cause, it creates two problems. It could create the impression that the government has decided that these non-bank SIFIs are truly too big to fail, and they will get special assistance should they get into trouble. I mean, people that passed Dodd-Frank say, no, that would never happen. I disagree. I think it creates a class of institutions that are identified as being different and more important than the other institutions, which isn't a good idea. And the other thing is the extra regulations involved are costly and problematic. MetLife has spent huge resources trying to defend itself against this case. The FSOC has the unlimited resources of all the agencies on board, including the New York Federal Reserve and the Federal Reserve Board and their staff of economists, to create arguments and ideas, and MetLife has to defend itself against that. It's tremendously expensive.
Mr. Ireland, can you add something to that?
Yeah, let me add one other point here. By being designated a SIFI, you become regulated by the Federal Reserve Board, which is a bank regulator and understands a bank regulatory model. And whether that model is appropriate for GE, a large diversified company, or an insurance company, of which there have been a number of designations, is really debatable. The expertise and the usefulness of that model for that purpose, I think, is questionable, and I think that FSOC would have been better served to think about more carefully about the tools it has and the classes of people it designated, rather than going through the sort of ad hoc designation process that they've used. So I think greater transparency in the overall process would be better for the designation process and provide more certainty to market participants and give them more confidence in going forward in the economy.
A final question to, again, Mr. Kupiec and Mr. Ireland. Have these SIFI designations made the American economy safer?
Definitely not. One of the unfortunate aspects of SIFI designation is we're designated non-bank SIFIs before there's any rules or regulations that have been written to suggest how they're going to be regulated. What is the regulation that's actually needed by their SIFI designation? We're designating them first, and there is no standard for regulation that has been put out yet. And another issue that's significant is Section 600 in the Dodd-Frank Act. There's a power that gives the Federal Reserve Board the right to draft prompt corrective action rules for the components of designated SIFIs. So the Federal Reserve Board, right now, there is prompt corrective action applies to banks. There's no prompt corrective action per se by any federal regulator for an insurance company, for a broker-dealer. The SEC has rights there, but one of the sections of the Dodd-Frank Act gives the Federal Reserve Board power to draft prompt corrective action rules over these non-bank SIFIs it regulates. So it comes back to Ollie's point that, you know, what expertise does the Federal Reserve Board have in exercising prompt corrective action rules and judgments over things that it really hasn't regulated over its lifetime?
Thank you for your testimony. I yield back.
I'd have the chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Thank you, Mr. Chairman. We've got a lot of bills under discussion today, and most of them are pretty good. The first is the Community Bank Capital Clarification Act, and I think that the importance of this bill, its fairness, could be illustrated by the fact that if you had two $14 billion institutions, even 10, 20 years from now, they just happen to be at $14 billion apiece, and one of them would have one rule, but the other would have a different rule because back in 2009, it was $16 billion. Obviously, we ought to treat identical banks identically, and if the bank is below the threshold, it ought to be below the threshold. The idea that you would have the mark of, I don't know what the mark would be on the forehead of the bank, because it was over the threshold decades ago, would treat identical institutions in a non-identical manner. I've co-sponsored the National Credit Union Administration Budget Transparency Act because I think it does make sense for an organization to publish its budget and to hear from folks to comment on it. There's some concern that all of the comments will be to tell the NCUA to do less regulation. People who raise that fear have never met anyone from the ICBA, but I am confident that the ICBA will have comments about the credit union administration's budget. I think the witnesses have already talked about the importance of allowing mortgage professionals to move from one job to another and to bring their skills. It is the unskilled mortgage professionals that can get us into trouble. And that's why I think Mr. Stivers has a good bill, the Safe Transitional Licensing Act of 2015. Let's see. A fourth bill is preserving capital access and mortgage liquidity. The FHFA says we need to fix this problem. We need to extend parity for credit unions under $1 billion in assets. And I look forward to co-sponsoring that bill. And I would go on at length about H.R. 2209, Mr. Messer's bill, to require the federal banking agencies to treat certain municipal obligations as Level 2A liquid assets. But the gentlelady from New York, Judge, does such an excellent job of explaining the importance of that bill that I don't have to. I'll ask the witnesses whether they have any comments on those four bills, and if not, I may shock my colleagues and yield back my time before I've gone over time.
I have one comment on 2209. I would also recommend that the committee consider Level 2A and 2B treatment, that the ones that qualify for 2A, as the bill is written, should be allowed as 2A. I don't understand why you wouldn't also want things that qualify as Level 2B assets to be recognized as Level 2B assets. It just, if they meet the standard, why not recognize them?
Maybe that's something we do in this bill. Maybe it's something we do later. And I know I look forward to working with the author on that and deciding whether we try to get it all done in one bill or not. And seeing no further comments from our distinguished witnesses, I yield back with over a minute.
I thank the gentleman, and now the gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thank you, Mr. Chairman. With respect to H.R. 3340, Mr. Emmer's Financial Stability Oversight Council Reform Act, which I'm a co-sponsor of that legislation, and I appreciate the leadership of Mr. Emmer on this important transparency measure. My question to the witnesses is in response to Mr. Stanley's argument for the need for political independence. I believe Mr. Stanley's phrase was the reason why FSOC's funding is not subject to the appropriations process or congressional review of how these fees are used is the need for political independence. Of course, in the Declaration of Independence, Thomas Jefferson talked about the fact that governments are instituted among men deriving their just powers from the consent of the governed. And I think Mr. Jefferson, as a founder of our country, would be troubled in finding that so many of the regulatory agencies in our country are not instituted among the American people based on consent of the governed, but instead on this principle of the need for political independence. That to me resembles more like the institutions that we saw in the Soviet Union instead of a democratic society where governing entities are subject to the consent of the people. I'd be interested to hear from the witnesses about Mr. Stanley's argument for the need for political independence and why more transparency is not a good idea. Dr. Kupiec?
Yes, first of all, I'm not going to comment on your comparison of the FSOC to a Soviet-style agency. I'll leave that one alone. But the FSOC is not an independent agency. It's chaired by the Secretary of the Treasury, who is, I think he works for the President, last time I checked. The head of the OFR has an office in the Treasury, meets with the Secretary of Treasury by his own volition all the time in regular meetings. It is essentially functioning as a research arm of the Treasury. I do not see this as an independent agency, the way it's run, so this argument of independence, I think, holds no water. And I share your concern that this notion that some of the banking agencies' budgets should be completely off limits from public scrutiny because they have to be independent. I think they work for the public, and the public has a right to know things about the budget and what things cost, and I think that's all part of the process.
Mr. Ireland? I would agree with Dr. Kupiec. I would add that the Secretary of the Treasury is not just the chairman of FSOC. The Secretary of the Treasury's vote is required for many of FSOC's actions, and the idea that therefore the Secretary of the Treasury is an executive head of an executive agency and is subject to removal by the President for policy disagreement. So the idea that FSOC is some sort of wholly independent agency, I just don't think it's true. And I would agree with the thrust of your comments. I think there may be places. I came out of the Federal Reserve and would be a little bit concerned about lack of budgetary independence for monetary policy because I think there's some potential abuses there. But I don't think that same argument applies, for example, to the Federal Reserve's bank supervisory function or the other bank supervisory functions. It's nice for them to be independently funded, but for them to justify why they're spending their money, or maybe they should be spending more money on other things that would be evident through the public process, I think is probably in the public interest.
Mr. Stanley, why is it that the American people shouldn't expect accountability to them through their elected representatives in Congress?
Yeah, if I could just defend myself here against the charge of Soviet tyranny, it would be, I do believe that the American people should expect accountability, and I do believe I may not have expressed myself as well as I could in my written testimony, because I do believe that everything we do here in Washington, D.C. Does have a political component to it, and appropriately does have a political component to it. But the question is, how do we design our political institutions so that the public interest is respected as opposed to a narrow special interest? And in the world of financial regulation, there's enormous amounts of money at stake, And there are narrow special interests with a lot of money at stake, so we try to insulate, to provide some insulation from those special interests.
Thank you, Mr. Stanley. Since my time is expiring, just if the witnesses could also speak to Mr. Stanley's argument with the Taylor Act, that there's, as to his assertion that there's inadequacy, his assertion that the existing regulations already tailor, and what about the inadequacy of those existing tailoring efforts by the regulators? Dr. Kupiec?
I'm going to have to ask the gentleman, ask the witnesses to respond.
My time has expired. I'm sorry we won't be able to get to that question. Thank you. I yield back.
I now yield to the gentleman from Minnesota, Mr. Emmer, for 5 minutes.
Thank you, Mr. Chair, and a special thanks to the panel for being here today. I'm sure that most of us on this committee can agree that financial regulators play an important role. I expect that most of us will also agree that financial regulations are best administered when there is the appropriate and necessary balance between Congress, the industry, and regulators. As one of you have testified, quote, significant disruptions to our banking system almost always trigger legislation designed to address the problems that led to those events as they are perceived at the time. Later on, with the benefit of hindsight, it often becomes apparent that our bank regulatory system has become unnecessarily complex and constraining, whether due to the remedial legislation or to the normal evolution of banking services and markets. In fact, as elected representatives, we should not only be doing anything within our constitutional authority to address any issues that can trigger serious disruptions to our banking system, but we should also be doing everything in our power to prevent bailouts and bailouts with taxpayer dollars. The Financial Stability Oversight Council, also known as the FSOC, and the Office of Financial Research, more commonly known as OFR, were created by the Dodd-Frank Wall Street Reform and Consumer Protection Act. The question for our hearing today is how we can improve the function and the ability of the FSOC and OFR to achieve their statutory mission by enacting reform that recognizes the importance of congressional oversight to enhance transparency and accountability of these government-created entities to allow for better stakeholder participation. If we agree that this committee should be working with both the financial services industry and regulators to prevent future crises and bailouts, and most importantly, to better protect consumers and taxpayers, we should also be able to agree that minor changes at the FSOC and OFR will not only enhance their ability to perform, but would create a more open environment where the benefits and the costs of FSOC's actions can be examined and debated in the open. H.R. 3340, the FSOC Reform Act, reaffirms the constitutional principle of checks and balances. Congress has and should have responsibility for oversight of government-created institutions to ensure that the regulation these institutions put in place actually help and not harm Americans. FSOC and OFR are no exception. I believe the FSOC Reform Act will provide an important and necessary check and balance, and with appropriate congressional oversight and enhanced transparency, the FSOC and OFR will be better able to perform for our financial industry and for our consumers. And with that, I would ask Dr. Kupiec, it's a very simple bill. Can you tell me, going to this argument about independence, which, by the way, we're dealing with an organization that we've just heard testimony. You've got the Secretary of the Treasury that sits on it, sits on the FSB. You've got, you literally have every one of these heads of these agencies, the 10 voting members, are appointed by the president. I expect are card-carrying Democrats, so I don't know how you take the political aspect out of this institution. Dr. Kupiec, if the OFR is still going to be able to collect the assessments, how would this impact, if we're not talking about budgetary constraints, we're just talking about an appropriation process, how would this impact, if at all, the independence, the so-called independence of this agency to do its job?
I think the independence argument is kind of a bogus argument. I think what the bill would do would be to put the OFR budget under oversight and supervision where it belongs. The Congress would have a say. I do not think, since the OFR budget funds the FSOC, The notion is somehow this would squeeze the FSOC's budget. I very much doubt that. And for one reason, the FSOC is staffed in large part by staff of places like the Federal Reserve Board and the New York Fed, who can second people there and pay them Federal Reserve Board salaries and Federal Reserve Board benefits. So the FSOC is not going to be starved for talent by this. It is merely the process that government agencies should be put under. Congress should be appropriate their budgets. My understanding is that the assessments would still accumulate. It's just that Congress would decide how much of those they can spend and for what reasons, and through a process, a give and take process. So I don't really see a big problem with it. I think it's a big step forward.
Thank you. My time's expired. I yield back.
Thank the gentleman. And now the gentleman from Pennsylvania, Mr. Rothfuss, is recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate the conversation we're having about regulatory relief for our local Main Street institutions. I'd like to turn a little focus, Mr. Ireland, if I could. When you appeared before this committee in June, we had the opportunity to discuss a piece of bipartisan legislation that I had introduced, H.R. 1660, the Federal Savings Association Charter Flexibility Act. As you may recall, the bill permits a Federal Savings Association to elect to operate subject to supervision by the Office of the Comptroller of the Currency with the same rights and duties of a national bank. You spoke favorably about the bill, stating that it would save time and money, streamline our regulatory system, and would appropriately balance caution and restraint with the ability to innovate and to provide financial services to consumers and businesses. Am I correct in understanding that you still hold those views?
You're correct.
Thank you. Well, today I'd like to continue that discussion about thrifts and mutual institutions and talk about the regulatory burdens that these institutions face and their ability to grow to meet the needs of their local communities. On a basic level, can you please describe how mutual banks differ from other types of financial institutions and how they are going to raise capital?
Well, mutual organizations derive their funding from their customers and build their capital base through retained earnings. And stock organizations obtain their capital by issuing securities into the markets. It makes it, the growth of capital in a mutual organization is a much slower process, and to adjust to significant capital changes, for example, as have been flowing out of Basel III, is more difficult for a mutual organization. In addition, I think that many of the capital rules are designed to deal with problems as they were observed in stock companies. And this particularly goes to the capital instruments issue that I think you're referring to. And how those rules affect mutuals, I think, is a separate question. And the assumptions you make about market effect of Tier 1 capital and the Tier 1 common equity capital in a stock company simply may not apply to a mutual. You may not have the same kinds of concerns in the mutual that you have in the stock company. And I think tailoring capital rules to mutuals is something that ought to be done, and the regulators ought to look at that very, very seriously.
I'm glad you raised that, because I've introduced another common sense bipartisan piece of legislation, H.R. 1661, the Mutual Bank Capital Opportunity Act of 2015, which would provide mutual institutions with the option of issuing a mutual capital certificate to raise additional capital without sacrificing their structure. By statute, the certificates would qualify as Tier 1 common equity capital and share many of the same qualities as preferred stock. Do you have any comments about this proposal?
I would support that proposal. I think that there could be details that need to be worked out as you go forward, but I think that something needs to be done to accommodate the mutual organizations. Otherwise, ratcheting up Tier 1 capital may simply strangle them and put them out of business.
Dr. Kupiec, at a recent roundtable discussion in Pittsburgh, one of my local community bankers stated that the current regulatory environment is, quote, as harsh as it's ever been, harsher. Another local banker described the federal regulatory environment as, quote, death by 1,000 cuts, and pleaded that community institutions, and he emphatically stated this, need help now. This Congress, the committee has, in this Congress, the committee has already marked up a long list of bills that would help fix this, and we're considering more good bills today. In your opinion, what is the one proposal that Congress could pass tomorrow that would make the most difference?
Of these 7?
Or any of the bills that we've done to date, these 7?
I wouldn't have all of them off the top of my head, right? So,
would you agree with the assessment that the regulatory environment is harsh?
yes, I would, and I think the bills asking for relief or requiring relief are fully appropriate.
And do you see the same kind of urgency for regulatory reform that this community institution would have been telling me about?
I think they're telling you the truth.
Mr. Ireland, any idea on what one proposal that Congress could pass tomorrow that would make the most difference for community institutions?
I don't have the time to list them all. I can't get it down to one. I think you have very serious problems right now.
I thank the gentleman. Now the gentleman from New Hampshire, Mr. Ginta, is recognized for 5 minutes.
Thank you, Mr. Chairman. I also like to thank the panel for the discussion today of these legislative initiatives. I've got 2 areas of focus. One very quickly on H.R. 2987 for Mr. Ireland. Can you specifically state how many institutions H.R. 2987 will benefit at present?
I haven't had the time to go back and examine the historic call report or reports. It's not call reports, it's the holding company reports that you'd have to look at to identify those. I understand that there are at least 2 of them.
Yep.
And I don't think the number is what really matters. I think the statute is just drafted wrong, and you want to fix that glitch in the statute. That's not the way you ought to draft grandfathers. And they've grandfathered the instruments. They don't want new trust preferred issued, but the institutions that have issued them, whether they're below or below $15 billion, is a completely separate issue and doesn't promote in any way evasion of the purposes of the capital rules.
Okay. Thank you. I want to move on to a different issue now on 2287. The NCUA operates independent of the congressional appropriations process. Their annual operating budget is used to carry out a list of duties such as examination and supervisory authority. However, a substantial portion of NCUA operating budget is funded by a fee from federally insured credit unions across the nation. This fee is based upon the prior year asset balance and rates that are set internally by the board. Our federal agencies, I think, need to be transparent. They need to be accountable. I don't see much problem with that. I also took a look at the budgeting over the last decade, and it appears, for the most part, that the budget has gone up. I took a look at the testimony earlier this year on July 24th, I think it was, by Ms. Matz, and I want to talk about that testimony a little bit. And I want to talk to Mr. Stanley about this. Back on that date, she testified, and I believe the gentleman from Georgia, Mr. Scott, was asking the questions. And she made a statement, and the statement was this: I don't believe that the credit unions necessarily represent the members. And if they did, they wouldn't be asking us to cut our budget, because I think the members would like us to protect their life savings and would like us to have the resources that we need to do that adequately. That was her statement. I, in full disclosure, am a member of a credit union. I wonder if I could ask you, first, one question. Do you know a woman by the name of Barbara Cunningham? Do you think Ms. Matz knows Barbara Cunningham?
Oh, sorry, I couldn't say, but possibly not, yeah.
I'll tell you who Barbara Cunningham is. I know her. She's the loan officer at St. Mary's Bank, which is the oldest credit union in the nation, that helped my wife and I get into our home. I trust her. I don't trust a faceless bureaucracy in Washington. So I have significant problems with that one statement that Ms. Matz made, because it suggests that the bureaucracy in Washington cares more about me than the person who lives in my community, who works with me to try to find a way to get a mortgage for a home for my wife and my 2 children. That is the fundamental problem I have with this notion that Washington knows better than people back home. I served as a state rep, I served as a mayor, I served as a city alderman. I've known the people that I do business with for years, and I have a relationship with them. That is the fundamental obligation and responsibility that I think people feel when they, as customers, go into a credit union and have that direct relationship with. So when your statement earlier suggested that the transparency is not necessary, I find that hard to believe would be problematic in order for NCUA to do their job. I think they can do their job. They can show the public how they're spending their money, and the consumer also can have a relationship, and a good one, with their credit union. So unfortunately, my time has expired, and I can't get your response, but I'll send you a written letter and ask for your response, because I do want to give you the opportunity to respond. And
Absolutely, thank you.
I thank the gentleman, and now recognize the gentleman from Indiana, the chairman of the Republican Policy Committee, Mr. Messer, for 5 minutes.
Thank you, Mr. Chairman. I want to join the chorus of support on H.R. 2209. Thank Ms. Maloney for her work on this legislation. I want to thank both Chairman Neugebauer and Chairman Henserling for their willingness to bring this bill forward. Others have talked about it, so I won't restate the statements made by others, but the bill is aimed at this remarkable situation that we have where federal banking regulators have excluded all American municipal bonds from being treated as high quality liquid assets under the LCR rule, creating the remarkable situation where not only corporate bonds, but certain foreign sub-sovereign bonds qualify as highly liquid assets when American municipal bonds don't. By the way, I should apologize for my voice. I was part of the 12th man at the Colts-Patriots game this week, and so we're proud of our Colts. Obviously disappointed in the outcome. You know, that approach, as others have testified, doesn't make any sense. These are great assets. They're among the safest investments in the world. They're often not traded because people want to keep them once they invest in them, but they're highly liquid in the sense that in times of financial crisis, folks can flip them if needed, as others have also testified, by discouraging these bonds from being treated in the way that reflects their true value. It drives up the cost of borrowing, which doesn't make any sense. I want to direct my question to Mr. Kupiec and potentially Mr. Ireland, not to go over what others have said, but maybe to make sure we get on the record. Do you see any reason why these assets should be discounted, or why the Fed, for example, should, because as you know, the Fed has come up with this rather Byzantine way of looking at it. Do you see any reason why those assets should be discounted, or should they be treated as the face value?
No, I think if you set specific criteria that the liquidity of the asset has to meet to qualify as a level 1, level 2A or 2B asset, that if they meet those requirements, they ought to be counted. And I would differ a little bit. The Federal Reserve is the only agency that's actually made a movement towards including some municipal bonds. So I think they're ahead of the rest of the regulatory agencies on at least realizing the problem. But I think the bill points in the right direction. If they qualify, if they have all the characteristics of a level 2A asset, why aren't you counting them as a level 2A asset? And I would add, if another segment of them qualifies as level 2B, then count them as level 2B.
And I appreciate that advice, and we'll actually try to work with the committee and Ms. Maloney to see if we can include that in this. We'll get to Mr. Allen in just a second. I might just follow up Mr. Kupiec very quickly. Could you comment just for a second about the problem with having the Fed, the OCC, and the FDIC having different approaches to these kind of bonds?
The The Federal Reserve rule would apply to any Federal Reserve bank that they supervise and holding companies. And so it would apply at the holding company level, whereas the OCC would apply at the bank level. So you might have a situation where if the rules don't all agree, the bank might have to have a different set of liquid assets than would count at the holding company level, which would just be unnecessarily complex. So I think it's better that the rules all agree, which is why this bill is also important. It tells all the agencies to come up with this solution, and I think it's the right.
Mr. Allen, do you have anything else to add?
I would agree with Dr. Kupiec. If the assets meet the tests for liquidity and quality, they ought to get treated in the appropriate category. And it makes absolutely no sense and will just distort markets and cause all kinds of problems to have different rules for different institutions. You need a consistent rule here, and picking and choosing by issuer as opposed to character of the asset, I think, is inappropriate.
Thank you. I yield back.
I thank the gentleman, and now the gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
I thank the chairman for allowing me to sit in on this panel. I'm not on this subcommittee, so I appreciate the opportunity to be here. Appreciate the witnesses for sticking through a long time and a lot of questioning. I think the bills today are a lot of common sense bills. Something Dr. Kupiec just said really made me think as we were talking about HR 2209. Dr. Kupiec, why do we have one set of accounting principles?
So we can compare across companies.
So
they're comparable.
And inside a company and across companies and compare apples to apples. Is that a great, an appropriate way of saying it?
Sure, you want every yardstick to have the same length, yes.
So shouldn't that also apply here when you're talking about across companies and inside companies with regard to assets? And if something meets the characteristics of a certain type of asset, shouldn't it be included in the asset? And shouldn't we have consistency so that we can compare inside a bank holding company at the bank level and across companies?
I think it makes a lot of sense to have one rule, yes.
So that's the kind of common sense stuff we've got here. One of my bills that two of you have talked about, and I think it's possible that Mr. Stanley does not have a position on it because he didn't mention it, is H.R. 2121, the safe transitional licensing. I think Mr. Ireland did a great job of explaining it to one of the other members of Congress who asked a question. I appreciate that. We are continuing to work with interested parties, and we have a new discussion draft that I think even makes the bill better. Instead of just a straight 120-day period, the new bill basically says the application or the transitional authority, and we make it an authority, not a license, so that the regulators actually can clamp down on folks if they need to, but it's good until the application is approved, denied, or withdrawn, or in the event that it's incomplete, the limit is 120 days if the application's incomplete. We also create the ability for the regulators to deal with bad actors. We make sure that we allow the regulators to require a background check if they want one. There's already something that says if you have been convicted of a felony, if you've been subject to a cease and desist order, or you've been denied or revoked or suspended for your license, that this process wouldn't apply. And I think Mr. Ireland talked about it pretty well, but Dr. Kupiec, do you want to talk about why we need the ability for folks in labor markets to move from employer to employer or state to state if they need to, and how that's good for consumers?
I think historically, one of the features of the mortgage business in the U.S. has been its ability to sort of expand quickly when it needs to and contract quickly when it needs to. Mortgage banking is, the business is volatile and this may or may not be a good thing, but sometimes real estate is more in fashion than others, and these people need to change jobs and move states. And My understanding of the law is in order to be under this 120-day grace period, or however you may improve that in the new bill, that you actually have to be on the National Registry. And so consumers would have access to your information on that registry while you were waiting for your new license. So to the extent that the information is a consumer protection, my sense of this is that the consumers would have access to that underwriter's, originator's information on the National Registry.
Exactly. Mr. Ireland, do you want to talk a little bit about how this is an unintended consequence of a two-tiered system? So we had a tiered system for state-regulated folks that had to have a license, and then the other folks who are at a bank who didn't need to have a license. And so when you want to change between them, you have to get licensed, but it was kind of an unintended consequence is that people then, if they want to change from a bank entity, a federal regulated entity to a state regulated entity, wouldn't be able to work for a number of months. That's pretty hard for most people to feed their family on, and it's clearly an unintended consequence.
Oh, I think so. I think it makes it very hard to move from a bank to a non-bank, and provides a very great deterrent in that regard, and cuts down competition between banks and non-banks. And I think this is in the interests of the originators. I think it's also in the interest of the efficiency of the market.
And the consumers. And Mr. Stanley, you didn't have a position on this bill. Do you like what you hear?
I like what I heard in the last 5 minutes, but since I have 200 members of my organization, freelancing on endorsements is tough.
I didn't ask you to endorse, I asked you to like what you hear. Thank you. I yield back the balance of my time.
Thank you, gentlemen. Now the gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Okay, all right. Thank you, Mr. Chairman, and appreciate witnesses being here today. And I apologize for being late and catching up here on a couple of things, but I want to talk, a little bit about. I don't know if you all talked about the municipal bonds, some already, but if you have, I'll move over to 2473, the Preserving Capital Access and Mortgage Liquidity Act of 2015. Can some of you talk a little bit about why H.R. 2473 is necessary and related to the community financial institution definitions, if any of you could be able to discuss that a little bit.
I think the issue is that the federal, the Housing Finance Agency, Federal Housing Finance Agency has issued rules about how large the mortgage activity has to be in an institution before you can gain Federal Home Loan Bank membership and be able to use Federal Home Loan Bank loans, pledging collateral. And I think this bill, there is a carve-out, I believe, for small banks under $1 billion. And I think the new rulemaking by the Housing Finance Agency would not allow credit unions to have the same access to the Federal Home Loan Bank as small banks. And I think my impression is this rule just kind of levels that playing field, so that if a small bank had access to the Federal Home Loan Bank, then a credit union would have access to if they're under $1 billion.
Do you think there's a sound policy reason for not including credit unions in that definition?
No, I think credit unions are appropriately, if they do mortgage business and they have mortgage collateral, I think the Home Loan Bank, that's their mission to provide liquidity, and in a lot of places credit unions are becoming more and more important. We heard earlier that they gave some of the members their mortgage, and I think small credit unions would benefit from accessing the consumers as well.
All right. Mr. Ireland or Mr. Stanley, would you like to comment on that?
I'd just like to point out, I think that the effect of this legislation goes beyond mortgage loans. I think it goes to small business loans and agricultural loans and community development loans as well, and those activities of credit unions. And it is I think it's strongly in the interests of the credit unions and the communities that they serve, that they have access to the additional source of funding through the home loan banks.
I have no comment.
All right, thank you. Could any of you mention or discuss a little bit about the the possibility, or the lack of exemption for small credit unions increase the possibility that current members in good standings will risk having their membership involuntarily terminated.
I think if you had a credit union and it was a member of the Home Loan Bank and it had loans from the Home Loan Bank, and for some reason during the year its business activity, its membership didn't want the loans or the mortgage loans or that would meet the limit, they would, I think they have 2 years actually, it has to be an average over 2 years. But if the membership stopped providing this service, even though the federal home loan lending may have been an important part of funding the credit union, they could face being cut out of the home loan bank.
Has the
access.
cap, I'm sorry, has the cap on asset size for community financial institutions been increased before?
There, in my preparation, I looked back at the old laws, and there is a 1999 amendment to the Federal Home Loan Bank law that for the community investment institutions, or there was a 500 million cap, and that was indexed to inflation, and so there's that limit. But I think the limit that this particular bill is trying to address is one that's being imposed by a proposed Federal Housing Finance Agency regulation, and not a Federal Home Loan Bank legal rule.
You think Congress is best to address this issue?
I think this is a necessary change to the statute. Looking aside from the Federal Housing Finance Agency's actions, I think if you look at the statute, this looks like it makes sense.
Thank you, Mr. Chairman.
Thank you, gentlemen, and I'd like to thank our witnesses for their testimony today. Without objection, I'd like to submit the following statements for record: Credit Union National Association and the National Association of Federal Credit Unions. Without objection, all members will have 5 legislative days within to submit additional questions, written questions for our witnesses to the chair, which will be forwarded to the witnesses for their response. I would ask our witnesses to please respond as quickly as possible. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And without further objection, we are adjourned.